Welcome to the Big Picture with Parky podcast. This is a series of podcasts where we will discuss a wide variety of topics and provide a rather different perspective from our experiences serving UK customers at NatWest. My name is Duncan Maccabe from the UK Corporate FX Sales Team. Today I am joined by Richard Turner from the Financial Institutions FX Sales Desk, Neil Parker, our FX Market Strategist, and we welcome back again Ben Nicklin from our FX Structuring Team. For the second podcast in this series, we are going to discuss how markets digest information, specifically data releases. Parky, I'll hand over to you first. Perhaps you can give a bit of a history on your experiences with data releases from your time in work.
Yeah, thanks, Duncan. I think that's a pointed way of saying that I'm older than everybody else on this call, although I think with Ben there might be only a slight difference in age. But yeah, in terms of the sort of 25 years plus that I've spent in the financial markets, things have changed materially in terms of the way in which we look at data. So going back to when I first joined, it was very much the case that we'd focus on things like trade data. Trade data was extraordinarily important. So was the sort of retail sales and activity data. So was jobs data, and clearly monetary policy decisions as well. If you think back sort of 25, 26 years ago, then we were looking at a different landscape as far as how things were released, but also how they were then digested by those monetary policy authorities to make up a decision for monetary policy going sort of some 2 to 3 years, or which would affect rather 2 to 3 years down the line in terms of economic activity. So those were the key indicators then. Now it's very much more about those government and central bank announcements, but they tend to be better trailed. It's also very much the case that jobs data has a much larger footprint as far as market interest is concerned than it had back 25 years ago. Things like PMIs, Purchasing Managers Indices, or survey data, and I can think of the German ZEW or IFO indices seem to have a very big impact. And instead of it being trade data, it's now about trade agreements, clearly because of recent events. So there has been a material landscape change in terms of what is important then versus now.
I was just going to say, just on that, when we were discussing this topic actually ahead of recording this podcast today, I dusted off a few old textbooks of mine that I'm sure Parky will have agreements and disagreements with. But one thing that grabbed me that was really interesting was what we were talking about 10, 20 years ago, right? I can't say that my career has been as long and as illustrious as yours, Parky. However, when I started in 2006, what we were talking about then is very different than what we're talking about now. And I'll give you an example. So the textbook I'm referring to is called The Secrets of Economic Indicators. It was one of the first books I bought when I kind of came into banking, just to learn about what data releases were and how important they were. One of the first chapters is on the non-farm payrolls, which, for the uninitiated amongst us, are released by the Bureau of Labour Statistics every month in the US, specifically from non-farming, i.e. non-seasonal jobs, and it gives an indication as to employment in the USA. And the first chapter literally starts with, "This is the big one," right? And as you're probably all aware, of late, this piece of data has specifically meant a lot less, purely because obviously COVID lockdowns is affected the validity of that information. But I decided to have a look back just 10 years to see how, as an example, euro dollar had moved after such a release. So 30 minutes after the data, by how far as a percentage had euro dollar moved from where it was on the release of that data? And going back to March 2010, the first kind of 3 or 4 were 30, 40, 50 basis points, 70 basis points in some instances. Where if you fast forward to the last kind of couple of years, there are very few readings above 20 basis points, i.e. the currency pairs are not moving by as much. I don't know whether this is something that chimes amongst your client base, Duncan and Ben.
One of the things that I find interesting, are we getting better at before answering your question, Dickie, are we better at forecasting and so we have fewer surprises, or does the market, even when there is a surprise, care a bit less?
I mean, I'll come in on this, and all I'll say is I think we're not getting better at forecasting as much as we want to sort of suggest that as a collective group, economists are getting better at forecasting. I don't think the data backs that up. I think the difference is that we can absorb the data much more quickly than we were able to back when I started, because it was very much the case that back when I started, you didn't have the technology in terms of dealing online. You didn't have the sort of array of different pricing systems, etc. But more importantly as well, in terms of the information and how quickly it got into the mainstream market, it got into the mainstream market much less rapidly than it does now. Everybody knows when the data releases are. That's primary importance. More importantly as well, they know what the market consensus is, and they know sort of what the range on those forecasts are. So I think in terms of our interpretation, we're able to interpret the data more quickly thanks to technology, but also thanks to being better prepared.
I think, Parky, as well, it's more about the rest of the market is looking upstream of the market releases as well. So maybe once upon a time, an announcement hit the market and it had a huge impact. Now, I think, as we're looking upstream of that, these things are sort of, we get more previews of what's going on. And obviously the sort of the archetypal information a blow to the market was the one in Trading Places. Now, as you said, Parky, you and I are about as old as each other, so we know that film Trading Places, but it was all to do with the orange crop report and the impact that had on the futures price. I think these days, something like that would be less likely to happen because you probably have more people out on the ground, sort of scoping the information about the crop as it's growing in the ground, for example, and as it's being harvested and as it's been put on trains to be shipped. So none of these things, when the actual formal orange crop report hits the market, it's no longer really a surprise. It's been presaged the whole way through. Do you think that's a reasonable statement to make?
Yeah, I do. I think the data back when I started in banking was all encompassing. That was the thing that everybody watched for. They weren't looking upstream. It was all about spot. It was how the spot rate would move, and consequently, the data had the ability to significantly affect the market. Now, you're right. It's not so much about the data itself. It's what it means for monetary policy decisions. It's what it means in terms of the decisions that governments are going to make. It may be also what it means with regard to those future trade deals that I was talking about. So it's more that the data drives future decisions, but probably doesn't drive them materially off course. And as a consequence, the reaction of markets is much less than it used to be. We're not focused on the now, we're focused on the future.
Yeah, well, certainly on the option side of things, as anyone who talks to me about these things will hear me say, is that the option market views the future volatility of an exchange rate not so much as a sort of a constant, but rather as almost like a Manhattan skyline, where a low-rise building is a very quiet or tranquil period in the market. So that's got low volatility. It might be a weekend or a bank holiday. And a high-rise building is something like a G7 summit or a central bank pronouncement. And over the years, certainly in the option market, what they do is they attribute weightings to each event. And those weightings are now a lot more similar to each other the highs and the lows are no longer as far apart. And that's all consistent with what we're saying about the consumption of data and its impact on the market.
I will say, Ben, on that, actually, it's a very interesting point because, you know, harking back to the trading places example, you're right. It was like a lot of other data. It was the only thing that investors had, right? It was the one kind of flag in the sand, if you like, or pointer as to where information was A, coming from, and B, you know, where things were going. And now I'd just like to look at a few examples of how this has evolved, and it's evolved quite significantly. If we talk about, let's just say in the UK as an example, and you know, with lots of talk about COVID recently, post first lockdown, one of the things that the economists were very keen on trying to understand was just how quickly people were getting back to normal, if obviously there was such a thing. And for that, we had to wait for consumer spending data. Of course, that is monthly in the UK. Office of National Statistics releases such data, and it tends to look at a basket of goods. What we kind of didn't really think about was how did those basket of goods evolve? What were consumer trends? But equally, alongside that, Google started releasing things like footfall data, so community mobility reports. This was almost real-time data tracking via people looking at Google Maps on their phones, all anonymized, all aggregated. It's tracking basically people's habits, whether they were at home, they were going to shops, they were out in parks. So this was changing the way that people looked at data. It's happening in emerging markets. India, as an example, uses satellite tracking data to look at El Nino effects on the monsoon season and whether onion prices are going to be high or low, which is a big component of the inflation basket over there. We're starting to see this consistent shift now to technology. And
it's funny you should talk about the satellites spying on the weather and the impact on crops, because that comes back again to our trading places example, where even before the crop has been planted, you're starting to get an idea about the success or failure of it. So it's incredible. But as you say, this transition to the drip of information, it didn't happen overnight. I'm thinking back to example, even when CNN was started, that was a big breakthrough in terms of supplying the market with information on a more continuous basis, rather than, say, waiting for the 10 o'clock evening bulletin or the morning newspaper. I mean, these things, it's been a continuous cycle whereby the flows of information have been more rapid and smaller than before, rather than being a sort of a stop-start.
And Ben, you mentioned the drip of information. And I don't think we've really touched on it completely, but the regular central bank events and sort of those that are flagged. It seems like the information is well signposted these days. How's that evolved over time? Because I believe that this was something that was very well scrutinized, as well as the retail data and the like historically.
I mean, I'll jump in on this in terms of monetary policy decisions. When I started, which is sort of back before, I think, Duncan, you were out of nappies. The business was looking at much greater political interference in decision makings from a monetary policy perspective. And monetary policy decisions could have happened at any time. There wasn't a clear timetable of when things, with the exception of the Bundesbank, who used to release more regularly, and we knew when the Bundesbank releases were. For the Bank of England, it was a political decision. That only changed in 1997. The decisions and releases now are well trailed. They were a total surprise back in the 90s, and even in the 2000s, prior to the financial crisis of 2008, they weren't giving forward guidance about what they would do. They weren't telling you what indicators that they were watching. You were meant to make up your own mind independently, which is why the variance of forecasts was probably wider on these sorts of things than they are now. Because you're getting all of the information. You talked about a drip of information. You get a drip feed of information from various speeches, from articles that are written. So central bankers are preparing the ground for what they're going to do to try and make it much, much less of a surprise.
And let's not forget, right, we talk a lot of age banter in here, but it's relevant, you know, when back in your day when you're getting pieces of data by fax, Parky, you know, now people tend to get them much quicker, i.e. the Twitter sphere.
Yeah. I'll give you one specific example, okay? Because that I know there's a dig in there, but I'll let it pass. I'll give you one specific example. When they started publishing the inflation report, the quarterly inflation report, okay, we had a courier at the Bank of England to courier it round to our offices so we could then read it. You didn't get a soft copy version on PDF or anything else, or published to the Bank of England's website. So the only way you knew about what was in the inflation report was when the hard copy arrived on your desk. We were very extravagant back in the day. We had 2 copies sent to us, so that my boss at the time and myself could read through it and read through different sections to make sure that we were covering all of the ground in half the amount of time. So that's one specific example of how the information flow is much better. You wouldn't get significant headlines on the inflation report because the first time the journalists had seen it was probably about 20 minutes beforehand. And they were picking headlines out of it, but there wasn't really much detail behind the headlines for a long period of time because they hadn't been able to write all of their copy.
So what's going to be the future then, Parky? So I'm thinking about a world potentially where inflation comes back, and with inflation coming back, does that mean that central bank announcements get the kind of importance placed upon them in terms of their impact on the market that they used to have back in the day, 10, 15 years ago? Is that a likely thing, or so we left that world behind forever?
I mean, I'd never say that we've left a world behind us forever. The world 20 plus years ago looks completely at odds with the world that we have today. And if inflation does come back, I think that will provoke a strong response from central banks. But there is one sort of counterbalancing factor, which is that central banks now have a myriad of things that they're watching, not just inflation. They were targeting inflation before. They're now looking at the labor market. They're looking at average earnings growth. They're looking at GDP growth. They are targeted with meeting objectives, not only to control inflation, but to also not interfere with objectives of governments to restore economic activity to things like pre-pandemic levels, or after the financial crisis, it was to restore economic activity as quickly as possible to pre-financial crisis levels. So I think the decision-making process amongst central banks is much more complex than it was going back to even sort of pre-2008.
Just to add to that, actually, Parky, you know, not just on the central banking side, but from the client's perspective, you know, the institutions that I speak to, pension funds and insurance funds investing longer term money, are looking at the big picture. They're not looking day to day at, you know, one-off data releases. That they want to build a longer term picture, and on the back of that, have many samples, right, of data before making investment decisions. Because again, you know, it doesn't now, investment decisions are made so that you and I can have a pension in 20, 30, 40 years time, not so that we can take advantage of the next 15, 20 pip move in euro dollar. So I've certainly noticed it myself. Conversations I have with clients focus on, yes, they're looking on high frequency data, but more now pulling in every source of data that they can, whether that be, again, Google Trends, Google Community Footfall Data, you know, spending habits as to electronic platforms, for example, digitization of currencies. Do you think that's the same with the corporate client base, Duncan?
Absolutely, Dickie, and I finally get around to answering your question from earlier on in the podcast. But yeah, I couldn't agree more, and I think it's very similar to corporates. The holistic view and long-term big picture is certainly more considered by the community, I think. Of course, there are sort of specific sectoral data releases that I think will have specific interests. So retail sales, I'm sure retailers will look at, but it wouldn't really affect their market decisions in the short term, I don't think. It's certainly the outcome of all of these things combined, which will then affect decision making on sort of the broad sense.
And I just want to come back and answer the point Ben made in terms of where do we go from here. Like, it's not just about inflation or any of the other things that I've mentioned. What we've seen from central banks in recent years is in effect yield curve control. You know, they're looking to try and suppress yields across the curve because that's where actually corporates are borrowing. More importantly, in terms of where we go with regard to data and data analytics, you're going to get more real-time or near real-time data that's able to be digested by the authorities. And where will that data come from? It can come from consumer spending. If the technology continues to advance in the way that we anticipate that it will, then you will be able to analyze how consumers are feeling on a much quicker basis than getting a consumer confidence survey that's a month in arrears or even a few weeks in arrears. So think about being able to analyze data that tells you about real-time changes in consumer spending trends. Analyze data that tells you whether or not people are spending or saving, depending on how confident or pessimistic that they feel. Analyze data that tells you where the next big spending consumption explosion is going to come from. All of that will better inform our authorities, better inform them in terms of where to deploy not macroeconomic policy, not interest rates, but the micro policy that you're already seeing, where they're trying to adjust things like we saw with regard to when they thought that car loans were getting out of hand. So they adjusted policy there. When they've tried to control lending into mortgages, you might be able to do that on a much more micro basis just because the data that we're able to consume in real time gets better and better and better. And that means that policy adjustments are potentially going to become more micro as well.
Thank you, Parky. And I think that's just to summarize, it is still important, the data. And I think we've certainly concluded that it's evolved and technology has been a huge disruptor of this. And it's going to be exciting to see how it continues into the future. I think where the big market impacts occur are going to be as well the big market events that sit outside of this data sphere, and we will discuss this in our next podcast 3. And thank you everyone for listening.
Thank you.